Today is May 2nd, 2020, and I will give you a lecture on two related topics. The first one is how expensive a house that you could afford to buy. How do you determine that when you set up to buy a house? And relate to that, in the overall national economy, how did we have 2008 housing crisis? Those two things are intricately related because in a personal level, in a macroeconomics level, what a household does and what all households collectively can will inevitably have impact on the national economy. Okay, let me start with the at microeconomic level, household level, as economics would put it. How do you decide? How do you figure out how much housing you can afford? So remember in my last lecture when I try to compare the differences of owning a home and renting a home. I explained for any individual, for a family to buy and own a home, there's three R's that should be there before you do it. The resources for the down payment, and the abilities to bear the risks of foreclosure and price decline, and the ability practically, financially, to handle the maintenance of property tax and homeowner association fees and similar payment obligations. If you can handle those three R's, we have concluded from the last lecture that generally it's more advantageous for you to own your own home, as it is in the long term cheaper than renting. At least that's true in the current economics, calculus in the United States, and it's true probably in most of the history of the United States. So it sounds sort of self-evident, but people tend to forget about it. You buy what you could afford. That's true in business. That's true also in your personal finance. Okay, but in early 2000, the beginning of the millennium, a lot of homeowners received mortgage loans. They mistook that, kind of approval of their mortgage application by the banks as the confirmation that they could afford the home that they're trying to buy. When in reality, they should not have bought the house because they could not actually afford it. So how do you determine if you could afford a home? How do you determine how expensive a house you could actually afford? It's, again, like you get into any kind of a loan transaction, right? Whether you try to buy a business or a house, you need to figure out whether you have future income, future inflow of cashes to pay off the loan, right? So you compare your future payment obligations against your future income. And of course, you have to leave a little bit of room, a wiggle room, a margin of error for the what ifs, meaning if you lose your job, if you have to relocate, you have to move, you have to look for a new job, or if you have any kind of emergency spending, right? What do? Do you have enough saving there to pay your monthly housing cost, including the mortgage and the property tax, the maintenance cost, right? generally speaking, the rule of thumb is that 28% of your gross monthly income, okay, should exceed your housing expenses, okay. Meaning, if you, for example, if you make $10,000, your monthly housing expense should not be more than $2,800, and that includes your mortgage payment, your property tax, your homeowner association fees, your co-op fees, and condominium association fees, and maintenance costs, and home insurance policy premium. Once you add the monthly payments, housing expenses on other debts like your student loan monthly payment, the total outlay of cash should not exceed 36% of your gross income every month. So that's rough, a very rough yardstick. You may want to be a little bit more even conservative than that. So as we did in the last lecture, we use an example of a house at a sales price of $250,000, which is the median single-family home price in the United States, roughly. And then assuming you get a conventional loan, which requires you to pay 20% of down payment, and the loan lasts 30 years, right? And if annual interest rate is 3%, your mortgage monthly payment will be about $843. If the annual interest rate goes to 6%, then your mortgage monthly payment is just like about $1 shy of $1,200. Okay. And then you have to also you can tell that if the interest rate varies, your monthly mortgage payment could change a lot. And you will, of course, affect how much you could afford in terms of a purchase price for a new house. And again, the devils are in the details, right? In different parts of the country, for example, in Georgia as opposed to New York or New Jersey, right? Property tax is quite different, right? In some parts of the country, you pay more than 2%, about 2% of your fair market value of your house and your property tax. But in some parts of the country, it's much less than that. Assuming it's 1%, then you end up, sorry, it should not be monthly mortgage payment, it should be property tax payment. If it's 1%, right, the property tax and the HOA fees is $208, right? But if it's 2%, it becomes $486, right? And same thing with the insurance. So for the same house, your monthly payment could be as low as $4,500 or as high as $7,250. So you have to do a very detailed sort of a budget. You have to figure all these specific elements of housing costs before you actually go to the bank and get a loan or even shop for a house. So now let's talk about at the macro national level, how did we get into the 2008 housing crisis? To put it in a very simple term, it's because as a society overall, too many of us get into a bad economic get into bad economic decisions when they try to buy more housing than they could afford. And specifically, that was sort of financed by a lot of mortgage loans made against the 3R principle. We had a lot of mortgages without down payment. So as I explained in my last lecture, when you, as a homeowner, did not have down payment, right, the bank would not have any cushion against any kind of price decline, because the purpose of the down payment is for the bank to make sure you have some sort of skin in the game before you run away from your home, before you abandon your home and by extension default on your home mortgage payments, right? So that's the purpose of down payment. One, if you have loans without a down payment, then if the price of the house goes down and the fair market value of the house is below the amount of the principal the homeowner owns to the bank, then the homeowner could just abandon the house and default on the mortgage, especially in states where the law does not allow the bank to go after the homeowner individually to reach that homeowner's other assets, assets other than a house. Then the homeowner will have an incentive to default if the house, if the price of the home goes below their mortgage balance. And then you have a lot of interest-only mortgage. Recall in my last lecture, I explained one of the advantages of owning a home is that your mortgage monthly payment is fixed. So you know that you can budget, you can plan. But if you have a floating interest rate, what if we go back to the 1980s when interest rate becomes 8%, then a lot of homeowners will not be able to afford the interest expense plus the principal repayment. And then you have, again, mortgage of not interest-only mortgage, then you have variable interest rate, which I just explained, right? But the interest-only mortgage is the same thing, because at the end of the day, you as a homeowner has to pay back the loan, the principal, right? And you cannot count on home price to keep going up. Because if home price goes down, then we go back to the first example, right? The amount of principal you own the bank is below, exceeds the fair market value of your house. Then the bank may run a risk of your default now because you have. So those are all kind of interlinked with each other. And that's why I strongly believe the conventional sort of fixed rate with down payment mortgage is the best mortgage for the entire health of our national economy, because that will force the homeowners to make prudent economic decisions. But back then, for various reasons, people were told, if you could not afford your mortgage, you can just sell your house because the price will keep going up, which is a very false assumption that you cannot count on anything for a price to keep going up. Why did we have that kind of a overall, microeconomic environment in which banks encourage you to take this kind of interest, this kind of loans that apparently do not serve the best interest of the banks? Here comes the concept of moral hazard. Moral hazard means essentially, in any kind of gamble or similar situations, heads I win, tails you lose. Now, specifically, if one party engages in risk-taking behavior, such like buying a house that you could not afford, right? Based upon favorable expected outcome, meaning the price goes up, right? But another person bears the cost in the event of unfavorable outcome. For example, you buy a house, but the price goes down. It's just not homeowners, also the banks that are guilty of trying to take advantage of this kind of moral hazard. How and why? Because the whole United States economy, the housing market back then rely on sort of this implicit guarantee by two sort of federal quasi-government agency, Fannie Mae and Freddie Mac, that they will guarantee the mortgage loans of American homeowners below certain sort of a amount, okay? And what does that mean? That means a lot of banks, they will figure, I don't care if homeowner defaults. The federal government, the Fannie Mae and Freddie Mac will sort of guarantee the loan and pay the principal back to me to the bank. And it's, of course, much more complicated than that. And then there is this, but in essence, that's what went on. And then there was also the securitization of the loan, meaning collateralized debt obligations. Loans, mortgage loans from all over the country, they were sort of packed together, commingled together. For example, Bank of America may have 20 loans, home mortgage loans in New Jersey, 20 in New York, 20 in California, and 10 in Nevada. And these 1,000 loans are bundled together and sliced into, 100 pieces, and then sold to all these different investors. And the investors were counting, on the banks and mortgage servers to receive the monthly payment and then give the money to the investors. And essentially investors all become, partially home mortgage lender. And and banks, they could, after they underwrite the loan, could immediately sell them, unloading them, and transfer the risk of these risky mortgages to these investors who did not really do their homework and check the underlying economics of all these houses and the financial circumstances of all the homeowners. And so a lot of corporations and investors bought those securities called CDOs, right? While the housing price keep going, when the housing market was doing well, the home prices, kept going up. You have one or two or three or five, homeowners in a given township. If they could not afford the mortgage, they could sell the homes, and then they will escape from, any kind of problems, because if they bought the house for $250,000 and could sell for $270,000, of course they could pay their mortgage. And I remember in 2007 when I was a law student, I was approved to receive from a certain bank, not to be named, home mortgage of $1.5 million in their branch in Queens, New York. And I was surprised that they told me, "Oh, don't worry, Mr. Liu, you can sell the house if you cannot maintain the mortgage monthly payment." I was like, I don't think that makes sense. But anyway, however, when music stopped, meaning when enough people could not afford their mortgage, right? Then when you have, supply of homes that exceeds the demand, right? Then you get into trouble. You trigger all these domino effect, this chain reaction. So when enough homeowners are behind their mortgage payments, right, house price would have to come down because there are just going to be so many houses for sale, right? And then banks, and a lot of other corporations did not know the value of these CDOs that they own because there are just so many of them. And there are so many houses behind those CDOs, right? And the banks start to refuse to borrow, to lend to each other. And the modern banking system is so complex that, you have to have You have to meet certain criteria in terms of the assets a bank holds, and including the CDOs, right? Before you can lend them to other banks or to other businesses. And then you suddenly the entire economic system has these sort of a credit freeze, these capital freeze. And there were insurance companies, AIG, that were greedy and foolish enough to insure these CDOs and counting essentially on the government bailout. So here's the moral hazard, right? The homeowners was counting for the bank, to sort of um, to assume all the risk if they have to default. The banks will assume, will hope was the banks hoped that their investors who bought their CDO will assume the risk, and everybody assumes the government. Fannie Mae and Freddie Mac will assume the risk if the housing market goes down, and then the entire economy almost explodes. So you have a waves of foreclosures, right? Because of simply people could not now pay the monthly mortgage payment to their banks. You could not find a house. You could not find a buyers, let alone buyers at higher price than what you paid for. And then millions of families lost their home to foreclosure. And there was even concerns for bank run. Actually, I remember my neighbors, actually went to the bank. Some of the well-to-do neighbors, they actually had more than $100,000 deposited in the bank, and they take some of the money out because at the corner, FDIC will only insure deposit of up to $100,000. And fortunately, or at least for the short term, we had the Fed Reserve Chairman Ben Bernanke, who started Great Depression as a career, helped the entire nation rescue the bank by essentially pumping money into the entire economy, and then by allowing the Federal Reserve to buy a lot of toxic assets, including the CDOs. But at least whatever the government did by pumping money into the economy, by essentially printing money into the economy, would probably have some long-term adverse effect upon our economy. You can tell as a result of that, after the housing crisis, our national debt as a percentage of our national economic output has gone up a lot. And once again, whatever we did individually in aggregate will have impact upon the national economy, and especially if there are a perverse incentive like moral hazard at play, then it's essentially a recipe for systematic risk and even systematic meltdown. And we still don't know what's the long-term adverse impact of the government rescue, financed by essentially taxpayers' money in 2008 and 2009. It may well be a factor that will contribute to the long-term issues we as a society, as a national economy, we have to face. That's the end of today's lecture.